For this video, I want to go over the real estate professional election that is available to some U.S. taxpayers that are heavily involved in the real estate space. Now, this is an election that can be quite valuable in helping free up a lot of what are otherwise suspended losses. But there's a lot of nuance to some of these rules, and a lot of taxpayers get trapped into thinking they qualify and they don't. So I've got an example fact pattern here for a taxpayer that is involved in some rental properties. And so we have one version of their return where they make this real estate professional election. I've labeled it at the top here so we could keep it straight. And then a second version where they don't elect real estate professional status, but they do claim the special allowance for active participation. But before we get into the return here, just quickly show you what we've got in front of us. So I do have an Excel workbook here, just a simple profit and loss for the 3 rental properties that this taxpayer is going to have. So we'll look at that. And then one slide here covering some background on these rules that apply to real estate, and then some more details on the fact pattern itself. Now, when we talk about real estate activities, we're talking mostly about passive activity losses and other passive activity income. So what is a passive activity? Well, passive activities are one of two things. So it's a trade or business, which you receive an allocation of income and you do not materially participate in that business. So an example would be if you're a limited partner in a partnership, in that you don't do anything in the partnership other than you just contributed some capital, that would be an example of a passive activity to you. The other thing that qualifies as passive activities are rental activities. Now, rental activities are per se passive regardless of your participation level. What that means is when you have income or loss being allocated to you from a real estate activity, the baseline rule is that this is going to be treated as a passive activity. It doesn't matter how involved you are. The theory behind the tax rules here is that real estate is largely just a passive activity, no matter how much you do with it. And so for those reasons, they should be considered passive activities and subject to those passive activity loss rules. This is important because the general rule here with passive activities is when you have passive activity losses, you cannot use those losses to offset non-passive income. So you can't use passive activity losses to reduce your earned income, let's say your W-2 wages. You can't use it to offset portfolio income like interest, dividends, capital gains. Those losses can only be used to offset other passive activity income. And then to the extent you don't have enough, they're just suspended and carried forward to future years. Now, there are some passive activity exceptions for rental real estate activities, and this is where the real estate professional election comes into play. So the real estate professional election is available if you spend more than half your time during the year in real property trades or business, and you performed at least 750 hours of services in that space. Now, real property trades or business is quite broad. It includes anything that constitutes the development, construction, acquisition, conversion, rental, anything to do with real property. So it is quite a broad kind of net as far as what qualifies here. Now, the alternative to this, if you don't meet this standard, and we'll talk about this standard a little more later, is the special allowance for active participation. This is something that most taxpayers find that they qualify for. So if you actively participate in managing those rental properties, you can deduct up to $25,000 of your rental real estate losses against non-passive income. Now, there are some AGI limitations that apply in this case, so you're not going to be able to claim these losses if your AGI is above $150,000. There's separate rules for married filing separate, but that's basically the threshold. So if your AGI is under 150,000 and you have rental real estate losses and you actively participate in the management of those properties, then you can deduct up to 25,000 of those losses, or 50% of the difference between your AGI and that $150,000 threshold. And when we look at the example, I'll show you where to find that on the form 8582. Now, let's look at a fact pattern here. We'll look at two, one of which is going to work and the other one won't. So the fact pattern we have here, the first one, we have Amy, taxpayer. She is working full-time as a consultant, and she's earning $360,000 a year, so a nice salary. Now, in 2024, Amy worked for this company for January, and she earned her $30,000 monthly wage, but she resigned on February 1st, 2024. She didn't like the space anymore. She wanted to get into the real estate business. So she worked for a month, resigned, and then she sold some stock investments, so she's going to have some capital gains, and she used those proceeds to invest in 3 rental properties. Now, she maintains good records, logs showing that during the course of the year, she did spend over 800 hours managing the rental properties, looking for new acquisitions, doing all those type of activities that you would if you were in this real estate space. So if we look at the time requirements, right, remember, it's got to be more than half of your time spent during the year in that space, and it's got to be greater than 750 hours. So if we look at the time requirements, we find that, well, she spent over 800 hours in the space, so she meets that element. But then the question is, did she spend more than half her time in the real estate space? Well, if we assume that she worked, let's say, 40 hours a week throughout January at that one employer, let's call it 160 hours as an employee. So she worked 160 hours during that job. She worked the other 800 hours in the real estate activities. So in this case, she meets the test, right? So she spent 83% of her time in real estate. So 800 dedicated to real estate activities of the 960 total hours that she worked during the year. So she is eligible to elect this real estate professional status. And so we'll look at how that impacts her return. So if we look at the examples here, if we look at the one first, assuming that she didn't make that election. Let's say she just wants to be able to claim the special allowance for active participation. Well, if we have a look at Schedule E, so this is where we report all of the rental income and expenses. She's got the 3 properties listed here. They're all single-family homes. And we could see a breakdown of the income and expense. So she has some rental income from each one of these, various expenses, but the net income or loss for the period for each property are all in the red, right? And that's not uncommon, right? Rental properties require a lot of upfront expense, and then there's the other non-cash expenditures like depreciation, often puts you into the red area. So for all of these properties, the collective losses here are in excess of $30,000. So if we look at the worksheet you put together here, these are the same numbers for tax purposes. All the losses for all the properties totaled up $34,417. Now, if we look at her return, the $34,000, if we go with that active participation threshold, it's going to be capped at $25,000. All right, so if we have a look at page 1 of her 1040, get a look at her income here, so we can see she's got that W-2 income from the 1 month in January, $30,000. She's got some capital gains on the sale of stocks totaling $59,000. And then we have the loss related to the rental activities, which is first reported on the 8582. So anytime you have passive activity losses, you need to complete the 8582. And the special allowance section is found in Part 2. So Part 2, we have the special allowance for rental real estate activities with active participation. And so we could see here the total losses for her were $34,417. The $150,000 is that AGI test, right? So your AGI has to be below that, otherwise you don't qualify for this loss. But when we look at her modified AGI, it's well below that, $150,000. And so she's going to be able to keep or be able to leverage $25,000 of that $34,000 loss, all right? Now, the excess isn't lost forever. It's just carried forward and used in subsequent years if you have a positive amount of passive activity income. But we can see in this case, she is getting to use the $25,000 loss. And so that is reported up on Schedule 1, Part 1, rental real estate losses of 25K. And ultimately that flows through to page 1 of her 1040. Now, when we look at her taxable income 49,000 and change, and the taxes she owes is $850. Now, that looks like a very low number for that amount of income, and it is because most of that income is long-term capital gains, short-term capital gains, so there's the lower effective rates, right? But what happens here if she decides, well, I think I qualify as a real estate professional, so how does this election change the outcome of my return? So if we look at the real estate professional option, the numbers don't change here. It's just a matter of how much of the losses she's able to carry through. So we still have the 30,000 in income. We still have the 59,000 in capital gains. But what we're doing here differently is we are treating these losses as a real estate professional. And so there is no passive activity limitation. And then there is no active participation limit on the 25,000. So because she's claiming this real estate professional election, she's deducting the full 34,417 against her non-passive income, which ultimately it adds an extra 10K losses, right? So she reduces her taxable income even more. So if we look at the 1040 now, with the real estate professional election, you notice all of this is passing through and being used in the current year. We're not just taking only 25,000 of the losses. So her taxable income is reduced a bit more, and now the amount of tax she owes is zero, right? So she doesn't owe the $850. Now in this example, it seems like a nominal amount, right? $850. What's the big deal? But for some taxpayers, those losses and the amount of their other income can be substantial. And so the swing between the taxes that you owe without the real estate professional election or with it can be quite large and quite meaningful. And so it's for those reasons that the IRS really audits these elections heavily, because they believe, and most often they're right, where the taxpayer does not qualify. Now, the other thing to touch on here before I leave the return is the election. So if you make this real estate professional election, you've got to show that you qualify with each individual property. And in most cases, taxpayers can't do that. And so what's often done is you make this election to combine the activities. So under Section 469, you have to file this election statement. If you miss it, that's a serious problem, right? The IRS will look for this election statement, and if you don't have it in there, then you can't aggregate the activities. You've got to prove your material participation with each separate rental property, which is almost impossible for most to do. So you file this election that says you're aggregating all these activities into a single rental real estate activity, and then you're good to go. Now, if we look at, go back to this slide here, I want to touch on this last fact pattern as an example, because this is where a lot of people fail the test, but they otherwise think they qualify. So in this example, we have, let's say we have John works as an engineering consultant, and he's a contractor. So he's not an employee, so he doesn't work the regular 40 hours a week. So he makes $200,000 a year in self-employed income. And he estimates that of that, he's working about 1,200 hours a year. All right. Now, because he's working 1,200 hours a year, he's like, well, I got time to invest in all these other real estate properties and spend time managing those. So he's got 5 properties, and he spends 775 hours managing those properties. Now, the total work hours for John is a combination of what he does as an engineer that's not in the real estate trade or business, plus the hours that he works in the real estate space. So for him, it's going to be 1,975 hours. So how did we get there? Well, we took the 1,200 hours he worked as an engineer plus the 775 he spent in the real estate space, 1,975. Now, although John exceeds that 750-hour requirement for the real estate, he fails the 1/2 time spent test, right? So if we look at his 775 hours divided by 1,975 hours total worked throughout the year, that's only 39%. So he spent 39% of his total activity during the year in the real estate space. The remainder of that was working as an engineer. So for John, even though he spends a substantial amount of time working on the real property trader business component of his career, he does not qualify as a real estate professional. And so you can imagine that a lot of individuals that are employees, right? So W 2 employees working a full or even part time job throughout the year, they're often not going to be able to meet this test. And that's because the hours spent working for their employer in a non real estate space put them in this bind where they can never get over that 1/2 time spent. The example we looked at previously with Amy is more often what you see. It's somebody who legitimately is just full time working in the real estate trader business space. So they will certainly meet the 750-hour element, and they don't have all this other work that's in the non real estate space creating this issue where they fall short of that 1/2 time spent test. And so it's really important for taxpayers to pay attention to this because very often when let's say they're doing their own return in TurboTax and they're just clicking a button that says, oh yeah, I think I'm a real estate professional. I do a lot of work in that space. And they click that button and they see how much it lowers their taxable income and their tax liability, but they're not really doing an analysis to see whether or not they qualify. So be very careful when you decide to go down this path of making a real estate professional election, because if you get audited and you can't substantiate the time spent, it's going to be a real problem. And then just as a final point, this election is also incredibly important, right? This election is necessary to aggregate these activities so you don't have to prove the material participation on an entity, or sorry, not an entity, but a property by property basis. And I've seen many audits go wrong where taxpayers make the selection to be a real estate professional. They forget the aggregation election here under 469, and it just blows the entire thing up and it doesn't work anymore. All right, so that covers it for this video. I hope that was helpful. I've got a variety of other videos on passive activity losses and how to do the 8582. I'll put those links below, so go check those out as well. And as always, I appreciate you sticking with me to the end here and for watching the video. And I look forward to seeing you guys again on the next one.